Nigeria's history, companies are hitting a trillion naira in profit after tax. Zenith Bank posted a 1.0 trillion net income for FY 2023, while gtco Holdings, that's the parent group of GT Bank, posted a 1.02 trillion net income. UBA, on the other hand, posted a 768 billion naira net income during the fiscal year, as Stanbic posted a 225 billion naira. That Stanbic IBTC Holdings posted a 225 billion naira net income for the same period. The banking arm of the group, Stanbic IBTC Bank, posted a 184.8 billion naira profit after tax. On the show this morning, we are breaking down these figures. Welcome to Economy and Market, where we give you a comprehensive breakdown of market and economic activities. I'm your host, David Origin. Higher interest rates, higher non-interest income, as some Nigerians will say, bank charges, have seen Nigerian banks post record earnings and record profit in 2024. In 2023, we saw them post record profits as Naira devaluation saw these banks record massive trading gains and in return, higher profits. As we entered the corridor of stability with the Naira, we saw as we entered the corridor of stability with the Naira in 2024, then we now saw the CBN impose 875 basis point increase in benchmark rate in 2024 that saw lending rates hit new high. Essentially, profit was driven by lending-based activities. If you look at some of the images on your screen, you see the level at which banking profits surged in 2020, 2021, 2022. We saw it at steady rates. Then in 2023, we basically saw a surge, and in 2024, we've seen all of them double 2023's profits because of increased lending rates. Higher lending rates, higher MPR is beyond lending rates. It also means higher yield on government securities. And further breakdown of banking income shows that banks not only made money from lending to customers, but also from government securities. Looking at the image on your screen, you see that there was a sharp increase in the percentage of interest income from government securities for these banks in 2024 than we saw in 2023. All the 6 banks listed on the screen, from UBA to GTCO to Zenith to Fidelity to Stanbic, all saw a surge in the percentage of interest income from government securities as against 2023. So, looking at the unaudited and audited financials, we saw UBA increasing its holdings of investment securities to 12.5 trillion. GTCO increased its holding of investment security assets to 4.15 trillion from 2.47 trillion in 2023. Zenith increased its investment securities to 5.1 trillion from 3.3 trillion as of FY 2022. The acquisition of investment securities led to a 1.2 trillion interest income on investment securities for UBA. For GTCO, these investment securities generated an interest income of 583 billion, a whopping 230% growth from the 176.5 billion recorded in 2023. Zenith Bank recorded an interest income of 1.04 trillion on investment securities, and in 2023, this figure was around 390.6 billion. Although unaudited, First Holdco, that's First Bank's financials, show that the group will generate around 849.7 billion as interest income on investment securities. That's a whopping 205% growth from the 278.5 billion generated in 2023. Essentially, Nigerian banks tended more to this risk-free asset, as we also saw in their impairment to net interest income ratio. For UBA, the impairment to net interest income dropped to 16.6%, but GT it was around 12.9%, while for Zenith, the impairment to net interest income ratio was around 38% from 55.6% in 2023. Basically, our banks we can say they are having their cake and they are eating it, and it has been like this for the past 2 years. Is this the new normal? What do we expect over the next couple of years? And on the show this morning, we have Oluwaseun Magriola, the head of investment research at STL Asset Management, on the show to provide insights. Good morning, Seun. Good
It's a
morning.
pleasure. Morning to you. Thank you for having me on the show.
Yes,
It's a pleasure.
I've said so much. I've said a lot of razzmatazz of invest interest income, government securities, increased borrowings. Maybe we can say net interest income. So, what's your take on the income and profit profile of Nigerian banks in 2024?
To be very candid, we've seen the banks perform significantly very well. We've seen them sweat their assets. We've seen them grow astronomically, more on the back of the high interest rate environment, more on the back of FX gains, and we've seen that impact or trickle down to their financials. We've seen net interest margin also rise astronomically. Like GT Bank grew their books between 2022 and 2024 like 5 times, and that has trickled down into solid profitability and them declaring solid dividend for their various investors. So far, so good. We are seeing the negative impact on the economy, but we are seeing the banks thrive on the back of the high interest yield environment. We are seeing the banks make significant returns. Actually, the top banks, GT, Access, Zenith, Stanbic, and UB, and that has really showed the resilience of the banks in the light of the volatile macroeconomic environment, which we've seen, and the harsh environment we've seen over time. Uh,
Okay.
I don't know if that
Yeah,
speaks to
yeah, yeah.
answers the question.
So basically, one question I have is the fact that, like you mentioned, you said a negative impact on the economy, and you also talked about GTCO's net income growing around 5 times. So Nigerian businesses are buckling under the pressure of heavy interest rates. I mean, the average lending rate is well over 30% from Nigerian banks. And we are seeing GTCO grow their net income. That's their profit even after taxation by around 5 times between 2022 to 2023. Basically, banks are balling out, but businesses are dying. The business environment is quite harsh for small businesses. So, what can be done to maybe, I don't know, create a form of balance between what we have with the financial services sector and the real economy?
Okay, yeah, you are very correct. We've seen a great disconnect between the booming fortunes of the banks as well as looking at it in tandem with the harsh reality of businesses. We've seen businesses bulk lower on harsh interest rates, very high lending rates, I mean, very high borrowing rates, and high FX in terms of FX play for raw materials and co. In terms of what can be done, I think the bulk sits on the table of the monetary and fiscal policy regulators, that's the government, majorly government and CBN. To ease businesses, I think government can do a lot with respect to providing special considerations for SMEs, like giving them a leeway to borrow in single digits that can help them in terms of improve their margin. Also, tax regulations too can also be tweaked a bit to favor SMEs in light of giving them tax holidays, trying to reduce their tax burden. And I think the government has also tried with this new tax reform, but a lot still needs to be done. Also, with respect to those who import, a lot of them import raw materials, so they are vastly exposed to volatility in the FX space, and the government can do a lot to hedge their volatility impact with respect to FX, because once FX spikes, definitely raw materials will go up and definitely the cost of production will go up, which will trickle down to prices of goods and services. And with inflation also impacting, it will make it more expensive for them to do business, and it will make them not return the much profitability we can see. And give or take, the SME drives the economy. They account for over 96%, over 90 to 96% of the Nigerian economy. And if they are not really performing, on the government really needs to intervene. So it's more for the government to find leeway to help the SMEs, and not necessarily the banks, because the banks will try to return maximize profitability for their stakeholders. They try to maximize returns for their stakeholders, whether the economy is favorable or unfavorable. So it's government that needs to create that soft landing for SMEs, looking at the overall impact on GDP performance and on the Nigerian economy.
Okay. So basically, your point is the government has like this is more of this lies on the it's more
On the
on the
government,
government side.
on the
But
government side.
but now I want us to just pay close attention to the kind of asset classes, the what's the word now? The asset classes of these banks, the kind of assets they are owning. We see them holding a lot of investment securities. That's government bonds, treasury bills. The question now is there not a risk? Is there not any risk attached to this? For example, we may say, oh, the Nigerian government is quite trustworthy, or we have higher risk ratings. In Ghana, if not, God save Nigerian banks in 2022 that they were not heavily exposed to bonds that were owned by governments, that were owned by the Ghanaian government. But we saw that thing lead to like a 1 trillion naira worth of losses for just 6 or 7 Nigerian banks. Is there not a potential risk or liquidity concern with this particular trend that we are seeing of increased holding of government securities? Is it not a
Uh,
risky venture?
okay, yeah, thank you very much. It is a risky venture, and there are a lot of risk aligned with that. Yeah, we've seen the banks increase their exposure to government investment securities, and with that, we see them being exposed to concentration risk, interest rate risk, liquidity risk, and credit risk. Now, concentration risk in the sense that if you have the bulk of your instruments in or your assets, which is your cash in government securities, if there's volatility with respect to the rates, definitely it will impact you. That is, if the government takes a or makes a sudden drop in interest rates, definitely, or they are trying to restructure their debt and the drop in interest rate, definitely is going to impact the bank's book, and we might see heavy losses. Now, liquidity in the sense that the business of the bank is cash, is to make cash available, is to ensure there's cash flow in the economy. And if the banks are exposed to investment securities that may be bonds, long-term bonds, and at a point they need to make cash available to sell those bonds, they might be selling at a loss, just create liquidity, and that exposes them to a lot of liquidity risk because they might not be able to sell, or they might not sell profitably, and that might impact their performance. Also, credit risk in the sense that some of them are exposed to subnational bonds and corporate bonds. Now, if anything happens to those state governments and they can't pay as and when there's a default with respect to even the corporate bonds, it will impact the bank's performance because they won't be able to make their obligations as and when due because of the default of those subnational bonds and corporate bonds. And also, with respect to interest rates, if they are holding long-dated bonds, they are having, and there's volatility in the system, so they can have mark-to-market losses, whereby the rates they are holding at, when rates is falling, it push them in a loss position. And so far so good. The banks are really exposed to risk, and because of that, they need to find a way to balance their books in terms of diversification related to asset class, related to currencies, related to geography. But what we are saying is we are seeing a lot of this bank hold government assets, which exposes them a lot. Like I said before, concentration risk, credit risk, interest rate risk, and the liquidity risk. These are the key risks the banks are exposed to. But so far so good, they've been able to manage their books. We are seeing the profitability, we are seeing the positive performance. I think we
Yeah,
will just enjoy it while the
it
whole thing
lasts
lasts.
for the shareholders. I'm sure
Yes.
it's a lot of it's a jolly
It's a
ride.
jolly moment
It's
for
a
them.
jolly moment,
Dividend,
especially for those who hold
we are seeing dividend
GTCO.
yield.
For those
Yeah,
who are holding GTCO shares, where they have to get dividend yield of more than 10%, we are seeing
more than 10%. For
Zenith
the first
paying
time in a very long while, we're seeing
that.
banking stocks do dividend yield at 10% and above,
I'm not
which
even
is quite
sure.
commendable.
I'm not sure any company is going to give up that kind of returns to their shareholders. I'm not sure any
And
company.
also to also chip in, for them to be declaring this robust dividend, this also shows that in terms of the recapitalization exercise, it
Okay,
shows they have internally crossed the hurdle, quote and unquote, because because most banks, I was thinking they would be more retained earnings, there will be less dividend payouts just to show up capital ahead of the 2026 deadline. But them coming out to push out this type of dividends, yield, this type of
but
profitability.
you also take into consideration the fact that CBN is not allowing them to recapitalize their retained earnings. They probably just the only way they probably can recapitalize it is by giving back to investors who will now
Oh,
give
now
back.
more of recycling.
Recycling.
Okay.
So,
Oh,
but
fine.
one thing
That's
I
fine.
want to pay attention to is trading gains. The trading gains. I'm looking at the trading gains figure. When you look at, for example, UBA generated about 659 billion in 2020. In 2023, in 2024, that figure dropped by 72% to 181 billion. In GT's case, they don't make so much from trading gains when in respect to, if you do the margin of trading gains, is around the margin of their trading gains to their gross earnings is around 20. That's for GT. It's somewhere in the region of less than 10%. Basically, they made around 82 billion from trading, based on a gross earning of around 2.2 trillion naira thereabout. don't you think our banks can make some money from, maybe they can reduce, like we talked about, concentration risk and the credit risk? Why is it not, this does it not make any sense for them to begin to look outside of, or just lending based activities, to start looking for how to make some profits from trading activities? Or I want to get your take, sir.
Well, for me, even okay, taking gtco as a case study, I think we are beginning to see the holding structure, as
Okay.
in the benefit of the holding structure, begin to crystallize. We are going to see the impact from them diversifying into other businesses, and we're going to see that impacts the profitability of the group as a whole. So, in terms of their pension, in terms of their payment solutions, we are seeing profitability trickle to the group as a whole. So, like I said, not necessarily trading. If they don't make money from trading, I don't think it would impact them negatively that much. So far, they balance their books. They have assets that can help drive the types of
Can help drive
profitability they are
profitability
looking
and growth.
for. Mm. So it's more how they play the cards properly. And I think for GTCO, we are beginning to see them efficiently manage their book. So in terms of loan to assets, they are very good. In terms of their return on investment ratio is very good. In terms of P ratio, this bank is a bank that's, I mean, GTCO is a company that is well and efficiently managed.
I
And I
call
think it's
them, I
more,
say,
it stems from that diversification, strategic diversification exercise, which
I tell people that
has
that
begun to yield
particular
to
group has an efficiency craze. I feel like
efficiency, correct?
they have like this craze for efficiency. They just want to be a model for efficiency in the Nigerian banking scene. So
Because
basically,
when you compare them to other banking groups,
it's
they far outperformed
so
on
okay.
efficiency ratios.
Now let's talk about this profit profile and recapitalization target. Recently,
Okay.
I wrote an article on BusinessDay where I said that banks need to raise around 2.47 trillion in the next 1 year in order to meet their recapitalization goals. So this profit profile, how does it help this level of profitability? With recapitalization underway, how do we expect a significant expansion in banking assets? Will we see more lending from the banks? Basically, what are your projections for the banking industry's trajectory going forward?
Well, I think it's going to be mixed because looking at it, asset quality still remains a bit of concern. Yeah, though the banks have remained profitable over the period, we've seen rise in cost of credit, we've seen elevation in non-performing loans, and we've seen sector-specific vulnerabilities. We've seen banks' exposure to oil and gas really sort of
Especially,
taper a bit because of the risk factors in those areas. So going forward, I just feel it's more around how they efficiently manage their books, more on the back of diversification, more on the back of playing to their strengths in terms of, okay, where are they looking at gains? In terms of loans, yeah, they can increase their loan book, but also they also have to see how they will manage their NPLs. Looking at the fact that we have a lot of fintechs that are efficiently doing better when it comes to loans than the normal brick and mortar bank. So for me, I think it's a mix. It's going to be mixed for the big banks, for the big players. I feel they have more value to extract. They have more profitability profile to grow their books and to be efficient with respect to their performance. But give or take, I see positivity down the line. I see the banks efficiently manage themselves, and I don't see this profitability trajectory go down in the nearest future.
okay.
That's my take.
So that
But
part,
asset quality is still a concern
before we round
for us.
up, that part where you said you don't see the profit, you don't see this profit trend going down the next year. So
Going
me, I'm
down.
looking at it
Yes.
from the perspective of, we are looking at a stable naira, right? The naira is, someone said, we're in the corridors of stability, and I've kept that particular term. We're in the corridors of stability. We are seeing inflation figures go down. We don't know, the MPC will likely hold rates over the next couple of meetings, but there's a high chance that they may cut rates this year. So
They,
now
they
that we
will
have
they will they
now
will
that we
cut.
have seen these two factors come together, what's your take for the banks? Because personally, I don't personally, just my personal opinion, I don't know if GT or Zenith is going to be able to make a 1 trillion naira profit in 2025 up to 2026. Do you, so what's your take? Or you to see them playing more to the bigger boys outside the country? For example, we've been seeing a lot of earnings coming from outside of Nigeria. Their earnings from outside of Nigeria has been increasing significantly over the past few years.
Well, for me, in terms of, okay, speaking to the monetary authorities, we expect them to sort of taper down on the monetary parameters with respect to MPR, respect to the corridor of lending, and because we've seen inflation, well, after the rebasing, we've seen inflation taper lower. We've seen FX stabilize more around 1,500, 1,600 level, unlike the previous crazy highs we had sometimes last year. So yes, we see things slow down a bit, but give or take, I don't still see it tapering above or below 100 basis points for this year. So even if they're going to cut 50 basis points, and that might be all for the year. So better to the banks, no matter what happens, whether there's volatility, whether there's inflation, I feel the bank on the good side or the bad side, if they are well positioned to make money, no matter the events that occurs. So for me, that's why I said I feel their profitability will not still go down. And most of them now are now trying to go through the trajectory of going to a holding structure where they can sweat the assets, where they can improve their revenue streams. So even if there's going to be a problem with the commercial banking side of things, they can leverage on their pension business, they can leverage on their asset management business, they can leverage on their payment solution. So if they are well diversified with respect to revenue streams, if they are well diversified with respect to how they manage their assets, yeah, I feel the profitability profile will not go down. I see this trajectory continue in the nearest future, except we see a significant withdrawal or significant events that can cause a sort of tapering, maybe like a COVID, like a global recession or something. But for now, as things are stabilizing, I don't see sort of, especially for the big players, the big tier one banks, I don't see this profitability profile go down.
Thank you.
So
thank you so much for
okay. Thank you very much
so
for
much
having
for
me.
your time. It's been insightful listening to you and your take on this particular issue. Thank you so much for tuning into Economy and Markets on BusinessDay TV. To the viewers, we'll be back on Wednesday next week. See you next week. Have a lovely weekend.